Rohr here with an early global view on Thursday, March 26, 2015. It is currently just after 7:45 a.m. U.S. Central Time. Coming to you a bit later than usual because we wanted to see the U.S. jobless claims this morning. And so far, the macro data actually has been improved by a reasonable bit, except for a few key factors like yesterday's U.S. durables that knocked the equities. What does all this mean to the markets? Well, so far today, following on the last couple days' weakness, and especially the big knock that the markets took from late morning yesterday in the U.S., are down an additional $13 this morning, down around 2,041. Now, that's actually off its worst levels. That was actually down around 2,033. Or into the sort of lows we saw on the pullback when the lead contract tested 2040 going back to the middle of the month. The low is back at that time, and that becomes pretty important as well, where this market's back below 2040 to, I guess, ultimately down around the 33 area from this morning, because the next support is until about 2020 to 17. And in slipping late yesterday, it overran some key support around the 2062 to 58 level. And of course, it had leaked out below that right in front of the Fed, actually a little bit of pre-Fed nervousness that was just there for a moment down to 2053. But the bulk of the trading was down toward 2058, 57, etc. And this is very important psychologically because that means that this area right here was the pre-Fed low. The market already gave up the pullback low we had pointed out would be very important coming into yesterday in the 2078 to 75 range, and we mentioned right away anything much below 2075 you had to look for that test of 2060 to 58 on Fibonacci. Previous historic congestion, big top of the January trading range after the failure off the January employment number. But it not only got there, but by the close yesterday was below 2060 to 58 and even 56, and that left it vulnerable, as we see. Now this feels like a true risk-off psychology. This has nothing to do with the data, which has actually improved a bit of late, especially in Europe. That explains a bit of the improvement of the euro against the dollar and the other currencies we'll get to shortly. But for now, if this market should rally back up, the supports now act as resistance. We would look for 2058 to 60, maybe even starting as early as 56 as resistance. And if it gets above that, you look right back up to 2075 to 78. And that pretty much does it for the short-term view of the S&P 500.